Diversification is one of the most important things to get right when managing a portfolio. When done properly, diversification can increase the rate of return you can expect from a given amount of total risk, or decrease the risk required to achieve a given rate of return. When some assets are rising in price, usually other ones are declining, which creates opportunities for contrarian investors to cycle capital into those undervalued assets. And in my opinion, having a small allocation to precious metals like gold and silver is a useful part of diversification, because they are partially uncorrelated with stocks and bonds and have different and unique risks and opportunities. There may be times where a larger allocation is tactically useful as well. This article provides extensive info on how to invest in gold and silver for part of your portfolio, including the pros and cons of various methods. Overview topics. 1. The role of gold and silver in a portfolio. 2. Two key challenges with precious metals investing. Ways to invest. 1. Method 1. Physical gold and silver coins, bullion. 2. Method 2. Gold and silver ETFs and options. 3. Method 3. Miners and royalty, streaming companies. Valuation approaches. 1. How to value gold. A deep dive into gold investing. 2. How to value silver. A look at silver's unique attributes. The role of gold and silver in a portfolio. Put simply, precious metals serve as a hedge against market volatility, political instability, currency weakness, and economic collapse. Because they are chemically unique, physically rare, and easily malleable, gold and silver have been used as money across much of the world for thousands of years. While they can be quite volatile, they historically store wealth very well over the long term. Benefits. Precious metals have no credit risk, maintain their global purchasing power over the long term in the face of inflation or currency devaluation, and aren't very tightly correlated with stocks, bonds, or real estate. Downsides. Commodities including precious metals produce no cash flows themselves and can be quite volatile. Most precious metal miners are historically poorly managed companies that lose a lot of money. Due to all this, whether investors should own gold and silver is surprisingly controversial. On one hand, there are people who distrust the global economic system and invest almost entirely in precious metals. On the other hand, many mainstream portfolios have zero exposure to precious metals, with some investors believing that no respectable portfolio should have any gold or silver allocation at all. This site is read by investors from all over the world. For many of them, you don't have to ask why gold and silver might be considered a valuable asset to hold. I've got readers from Greece, Argentina, Turkey, Nigeria, and virtually every country. Gold is at all-time highs in most currencies besides the US dollar. I think investors in certain countries like the United States get too complacent. They think a lot of the bad things that happen to other markets can't happen to their own, even if it has happened multiple times to the US in the past. We saw firsthand recently in 2018 when the currencies of Argentina and Turkey plummeted. Their stock markets cratered and bond yields spiked, meaning bond prices fell and inflation-adjusted returns for a variety of asset classes became terrible. These things happen from time to time around the world. Investors from those countries holding gold, or assets denominated in foreign currencies, they're the ones that made out well from the carnage in their domestic economy. How much should you hold in gold and silver? That's up to you and your unique circumstances. How old are you? Where do you live in the world? What's the rest of your financial situation like? Personally, I think putting 5% of a portfolio in precious metals is appropriate, and maybe up to 10% in some cases. If you invest too much, you risk missing out on the better growth historically offered by other asset classes. However, having no allocation leaves you exposed to certain risks that stocks and bonds can't always compensate for. 1. Famous Shark Tank investor Kevin O'Leary holds 5% of his portfolio in a combination of gold bullion and gold ETFs. 1. When gold goes up in price a lot, he sells some. 1. When it dips, he buys some more. 2. Hedge fund billionaire Ray Dalio similarly recommends holding a 5 to 10% allocation to gold as part of an all-weather strategy, a portfolio that holds up well in a diverse array of economic conditions. I think both of those examples are reasonable, and that a small allocation to precious metals within a portfolio that otherwise mostly consists of stocks and bonds and real estate is appropriate for many people. 2 key challenges with precious metals investing. Learning how to invest in gold and silver is challenging because directly investing in any commodity is filled with headwinds against you. First of all, commodities, including precious metals, don't produce any cash flows like a profitable business or even an interest-paying bond does. Instead, they just sit there, as you hope they go up in price. Gold and silver are good at holding their value over the long term against inflation, but apart from that, don't do a lot for you by themselves. Warren Buffett perhaps said it the best. Secondly, there are transaction costs associated with precious metals investing. If you buy physical gold, there's a company in the middle making a profit. They buy it at wholesale prices, turn it into fine investment-grade gold, and sell it at retail prices. There are potentially shipping costs, and there is a cost associated with security and storage, along with a risk of theft or loss. If you instead invest in an ETF that holds precious metals, they have an expense ratio, which covers security and all the administrative costs of managing the fund and their hoard of metal. So, not only does typical precious metal investing not produce cash flows and instead relies entirely on the metal appreciating in price, investors start at a loss due to the associated expenses along the way. There can certainly be a place for physical precious metals in your net worth as a long-term holding, and I have a sizable physical bullion allocation. Some investors use it as a hedge against catastrophic risk, like the collapse of a national economy, or a hedge against inflation risk or currency devaluation. However, it's also nice to get some income from the position. That's why my strategy for gold and silver investing is to hold a diverse mix of direct gold and silver exposure, via physical bullion and select ETFs, as well as precious metal streaming, royalty companies and select miners. The dividends from the companies pay for the expense ratios of the ETFs and physical holdings, so that the portfolio has a self-sustaining precious metal hedge. The rest of this guide discusses the pros and cons of holding precious metals in the form of 1. Physical gold and silver, 2. ETFs and options, or 3. Miners and streaming, royalty companies, and explains how to approach gold and silver valuation. Method 1. Physical gold and silver coins, bullion. The oldest method for gold and silver investing is just to buy some physical coins or bars. The advantage to the physical approach is that it's the safest, least complex way to invest in gold and silver. You buy some from a reputable vendor, and hold it in a safe place. However, it quickly starts to get more complex than that. Where do you store it, and how do you keep it safe? Personally, I think owning some gold coins tucked away in your home, and an envelope with a bit of hard cash, is a good idea. Physical bullion is a nice off-the-grid store of value. We've all seen areas that are hit by devastation, either economic or weather-related, where it's good to have some hard assets on hand. You can't always rely on banks or electronic payment networks to provide required funds during times of crisis. I'm not talking about zombie apocalypses here. Just your average run-of-the-mill major economic problem or natural catastrophe. In 2015, during Greece's economic crisis, a run on banks resulted in withdrawals being limited to €60 per day. You'd have to wait in long lines just to get a trivial amount of cash. In 2017, when Puerto Rico was devastated by a hurricane and the whole territory was without power, business couldn't accept credit cards and cash was needed for everything. But many banks were closed and others were limiting withdrawals to $100 per day. Again, there were massive lines at banks and a handful of working ATMs. That's why having some physical cash and some gold, silver coins stashed around for times of emergency is not a bad idea. But once you start getting to large amounts, it's unsafe to store physical gold and silver at your home. If you want to hold more, it's important to store it off-site professionally with security. This comes with regular fees, which eats away at your investment. Historically, gold and silver rise much faster in price than storage fees, but it can be volatile along the way. Bitcoin is another asset class that people increasingly use for this purpose, as it is outside of the traditional financial system. Method 2. Gold and silver ETFs and options. The easiest way to invest in gold and silver is to buy one or more exchange-traded funds, ETFs. The key advantage is that they are extremely liquid, and you can buy or sell them within your brokerage account. This allows for easy portfolio rebalancing and an inexpensive and hassle-free buying, selling process. Historically, these were kind of expensive, but they are getting cheaper. Here are the main options. Gold. 1. SPDR Gold Trust, GLD, expense ratio, 0.40%. 2. iShares Gold Trust, IAU, expense ratio, 0.25%. 3. SPDR Gold Mini Shares Trust, GLDM, expense ratio, 0.18%. 4. Aberdeen Physical Gold Shares ETF, SGOL, expense ratio 0.17%. 5. Sprott Physical Gold Trust, FIZ, expense ratio 0.46%. 6. Perth Mint Physical Gold ETF, AAAU, expense ratio 0.18%. Silver. 1. iShares Silver Trust, SLV, expense ratio, 0.50%. 2. Aberdeen Physical Silver Shares ETF, SIVR, expense ratio, 0.30%. 3. Sprott Physical Silver Trust, PSLV, expense ratio 0.67%. As ETFs become more and more common, the general trend is for them to become cheaper. The SPDR Gold Trust, GLD, ETF for example was founded back in 2004, and it's on the expensive side. Then the iShares version came out in 2005 and was a bit cheaper. Far later, in 2018, SPDR came out with their GLDM ETF, which is cheaper still. If there's a disadvantage, it's that they don't have quite the catastrophe insurance vibe that physical bullion has. Most of these ETFs aren't redeemable for gold and silver, and you don't physically have it in hand. So if there's a zombie apocalypse and markets go dark, you're out of luck. The exception to this is the Sprott collection of funds and the Perth Mint Gold Fund. These funds store their metals entirely in physical allocated bullion and are redeemable for gold and silver. These are safer to buy and hold. A tactic with some of the more liquid ETFs like GLD and SLV is that you can sell options on these ETFs to earn income from them. Here's the short version of how to do that. 1. Identify an ETF that holds your desired metal, such as the iShares Silver Trust, SLV, or the SPDR Gold Trust, GLD, that also has a liquid options market. 2. Sell cash-secured put options for shares of that ETF at a strike price that is below the current market price. 3. If the put options expire without being exercised, keep the profits from the option premiums and sell the puts again. 4. If the put options are exercised and you now own shares of the ETF, sell covered call options at a higher strike price than what you paid for the shares, and above the current market price. 5. Continue selling covered calls, until eventually the options are exercised and the shares are sold. 6. Start over, and sell cash-secured put options at a strike price below the current market price again. I refer to it as option weaving. You weave in and out of the same shares by selling puts and calls, collecting option premiums at each step. This strategy naturally results in repeatedly buying fairly low, and selling fairly high, and collecting option income along the way. When you sell an option on a stock or an ETF, you're selling someone the right, but not the obligation, to buy or sell the shares from, to you, depending on whether it's a call or a put, at a certain price within a certain time frame. And in exchange for that, the option buyer is giving you a cash premium up front. Method 3. Miners and royalty, streaming companies. There are a variety of gold and silver mining companies to invest in. You can also invest in a handful of ETFs that hold a basket of miners. The advantage of miners is that in theory they can get around a lot of the problems of precious metals investing. Whereas precious metals don't produce cash flows and cost money to manage, miners do produce cash flows and often pay dividends. However, gold miners are levered against gold. Whereas the price of gold might double or halve over a period of several years in extreme cases, from, say, $800 per ounce to $1,600 an ounce, or vice versa, gold miner stock prices could go up or down 5 to 10x. Suppose a gold miner has a free cash flow break-even point of $1,000 per ounce, so when gold is above that point, they have positive free cash flow. In simple terms, if the price of gold is currently $1,100 per ounce, the gold miner is making about $100 per ounce in profitable free cash flow per year for each ounce they mine. If the price of gold jumps to $1,500 per ounce and the gold miner's expenses stay the same, they're suddenly making $500 per ounce in profitable free cash flow. Their profits jumped 400% even though the price of gold only rose 36%. If gold then falls to $800 per ounce, the gold miner goes into the red and starts losing money fast and piling up debt and falling to a rock-bottom share price. If you're an investor in gold itself, you can wait out any downturns in gold price. But gold miners aren't so comfortable. If gold stays low-priced for long, they can go bankrupt before the price of gold rises again. It certainly is possible for gold to drop below all-in sustaining costs, AISC, for years if for some reason demand falls, because annual production only equals about 2% of the current gold supply. In other words, the market can stay irrational for longer than miners can stay solvent. In addition, gold miners are historically not well managed. They don't keep costs under control, and so they tend to miss out on the most profitable spikes in gold prices. They often make poorly timed acquisitions when precious metals are highly priced, which turns into a value trap when the prices fall back down to normal. As a group, they have low insider ownership and CEOs that are paid very high compared to the size of their companies. While there are some standout companies like Randgold Resources that know how to create shareholder value, the vast majority of gold mining stocks are just outright bad. A lot of gold mining stocks today are lower than they were in the 1990s. I occasionally dabble in a specific gold or silver miner, including selling options with them to profit from their volatility, but for the most part stay clear of this industry. Gold and silver royalty, streaming companies. When it comes to precious metal companies, I prefer to stick mostly with gold and silver streaming, royalty companies. If you're looking into how to invest in gold and silver, these companies are worth a serious look. Rather than operating mines themselves, streaming, royalty companies finance mines. They provide cash up front to develop a mine, and in exchange once the mine is active they get to buy a certain amount of gold and silver at far below market prices, or get a percentage of the output. Basically, a streaming, royalty company manages a portfolio of existing streams and continually makes new investments to acquire future streams. Gold and silver miners like to do streaming, royalty deals because if they issue normal debt, they are stuck with it regardless of the price of gold or silver. But by receiving money in exchange for a streaming, royalty deal instead, their streaming, royalty obligation is levered to the price of the metal they are mining. In other words, it's like their debts go up and down with the price of the metal and with their profits, so it's less risky for them. For investors, streaming, royalty companies are a less risky and less levered way to make money from gold compared to actual miners. In addition, unlike miners, streaming, royalty companies have historically outperformed the price of gold. They've also paid dividends the whole time, so their total return is higher than shown. There are only a handful of publicly traded precious metal royalty, streaming companies. On one hand, there are the big three established ones. 1. Franco-Nevada. 2. Royal Gold. 3. Wheaton Precious Metals. These three are the oldest ones, and have large portfolios of active streams, royalties. On the other hand, there are several up-and-comers. 1. Osisko Gold Royalties. 2. Sandstorm Gold. 3. Metalla Royalty and Streaming. 4. Mavericks Metals. These companies are younger and have a much larger share of potential future streams that are under development. They are riskier, but if their investments work out, their potential upside is very large.